So we're going to continue our discussion on the issue of working capital with particular emphasis on receivables and payables. Receivables and payables. So when we talk about receivables in current assets or under working capital management, we are simply referring to credit sales that is given to customers that will fall due at a later date. And talking about receivable management as it relates to working capital, the issue of receivable management is very important because sometimes when you give your customers some credit facility, you will discover that as at the time you are giving it to them, you might not need cash at the immediate. But after some days, you discover that there is need for cash. So at that point, what will you do? Because there is an emergency need for cash. So the objective of receivable management is to ascertain the optimum level of trade credit to give to customers or to offer to customers and how to manage that credit. That is, when you allow credit to customers, these will encourage sales, yes, to encourage sales. And more so, when you allow credit to customers, it will help you compete well among your competitors. Your competitors might not be giving credit facility, but because you're giving credit facility, it will attract customers to you. But as it is attracting customers to you, you must be very careful on how you manage the situation. Because when there is absence of this credit facility, it will encourage your customers to select an alternative supplier that is offering what more favorable credit terms. So the point is this: allowing too much credit or not managing the credit policy carefully enough could result in irrecoverable debt. Yes, when you give too much credit and you are not following up to see how you can recover your money, some of those credits can become bad debt. And even when they become bad debts, in the long run, they might be irrecoverable. So for a business not to run into laws as expected, there is need for proper receivable management. So in managing these working capital or receivable aspects of your working capital, it is very important you look at the costs and benefits of giving this credit. What are the costs of giving this credit? This is very important. And one of the costs of giving credit is the issue of what? The issue of finance cost. The issue of finance cost. Now, when you give credit to your customer, you need to manage that credit situation. So there is a cost associated with trade receivables. There is a cost associated with trade receivables. So the longer the period you are giving to your customers, the longer the costs of managing the receivable. Let's look at a situation of of managing the trade receivable. Let's look at the situation of managing the trade receivables. For this class, I don't have a particular note anyway, but I have a guide. Now, to manage accounts receivable, they need to manage or to establish a credit policy. Every business that wants to survive, that wants to keep operating till perpetuity, must have a credit policy set up. And the essence of the credit policy is to see how you can manage your receivable in an appropriate way. Now, what will be or what are those factors that will influence your credit policy, that will determine the type of credit policy you have to come up with? Number one, you can have the issue of the demand for your product. How well are you getting demand for your product? It will determine how you fix your credit policy. If your business, your customers are coming daily to demand for your goods, is a fast moving product, it means your credit policy should be very strict. But where your goods is not moving or are not moving very fast, it means you can have a credit policy. So the determinant of your credit policy, one can be the demand for your products, and two, it can be issue of competitors. When you have too many competitors and you want to keep surviving in the market, you can have a flexible credit policy. But where you are the king in the market, your credit policy can be very strict or tight. And also, the factors that can determine your credit policy, you can have the issue of risk of irrecoverable debt. Now, you look at your customers. What is their purchasing power? Are they credit worthy? Yes. This is also a factor that can determine your credit policy. And the issue of finance costs, as I've mentioned earlier, and the cost of credit control. The cost of credit control. As you give money to people, as you give your goods to people, you are not just giving them like that. There are costs associated with getting are what you have to consider before you set an appropriate credit policy for your organization. So one thing about credit policy is that a firm must establish a policy for credit terms given to its customers, because ideally the firm will want to obtain cash with each order delivered. That is the expectation. As you give goods, you want to get cash. But the fact that you're operating a business, there will always be credit issues. Credit issues. So as those credit issues comes up, you must see how you manage them. You must see how you manage them. Now, when you talk about credit policy has four main aspects. Credit policy has four main aspects. Number one, for you to come up with a good credit policy, you must assess the credit worthiness of your customer. What do I mean by that? And how do you assess the credit worthiness of your customer? I need somebody to speak to this. Some of you work in the bank and some of you are managers. Before
Hello,
you,
sir.
yes, ma'am.
Okay, good evening, sir. To
Good
talk
evening.
on the credit worthiness of the customer, I think before a customer is given a loan, there should be a collateral that can equate to that loan given to the customer or more than the loan given to the customer. In case if the customer fails to pay, they can sell it up to be able to recover the money given to the customer.
Okay, okay. I think your name. Um, yes, Madam Licia.
Good evening, sir. I don't know if I'm right, but when in terms of business, I think she spoke in terms of bank and that. I think that in terms of business, how to measure customers' creditworthiness is if it's kind of customer that if it's a frequent customer that buys in larger quantity or pays in large pays amount or like on time or buys in large quantity and pays on time. So like I feel that person, that customer is a credit worthy customer. Like, yeah, that's just what I'm saying.
Okay. All right. Thank you very much, everyone. So, assessing credit worthiness. A firm should assess the credit worthiness of all new customers immediately. And as a matter of fact, I know by the time somebody is new and the person is requesting for credit, you might not be willing to offer that credit facility based on this. So, what should be in case we are in an ideal society, once a new customer sets in, the key thing is to quickly assess its credit worthiness. For existing customers, even the fact they are faithful, they are credit worthy, there should be a way for you to keep evaluating their credit worthiness. And how will you get this information? You can get the information through bank reference, through bank references. That is, you can get information to their financial statements. You can ask them to get a reference from the bank. Yes, their bank will write on their behalf. And you can also get issues such as document information from your customers through trade references or publish information about your customers or credit reference agencies. And you can also get information from about your customers from their company sales records, from the company sales record or credit scoring. You know, there are some organizations that their credit rating is online. Yes, through their financial information, through their performance, you can get to know how well they are performing. So, bank references, a customer's permission must be sought before uh, the bank can write a letter of reference. That is, if the bank wants to write a letter of reference about me to a supplier, I'm supposed to be reach out to and give the mandate to the bank. Yes, go ahead to give to write about me to the supplier because these are information that are very important to the suppliers in order to be able to give me the appropriate credit that is required. So now, still talking about these receivables. Talking about receivables. Now, when you give your customers receivable and the receivable has fallen due over time, how do you follow up? How do you follow up? You can come up with a reminder letter. You can come up with telephone calls. You can come up with debt collectors, those that will help you follow up to collect your money. You can institute or constitute a legal action to get your money. Yes, because some customers can be so recalcitrant, and even when you call, even when you send reminder letters, they might not do the needful. So now, these are just discussions about that. The main point I want to drive at is the issue of the computation aspect. Now, cost of financing receivable. I've mentioned that before. Cost of financing receivable. Now, how do you measure the cost of financing receivables? And what do we talk? What when we talk about financing receivable, what does it entail? Financing receivable, what does it entail? Now, let's show how we can determine the finance cost of our receivables. Now, for you to determine your receivable, what will you do? What will you do? let's say finance cost. Finance cost. Finance cost. Please follow. This is very important. To determine your finance cost, your finance cost can be determined by what? Your receivable balance. Your receivable balance multiplied by what? Your interest. Multiplied by your interest. That is the interest rate. Now, the question here is, how will I get my receivable balance? How are you going to determine your receivable balance? How do you get your receivable balance from our previous class? Receivable balance. To get your receivable balance, what will you do? It will be your credit sales.
All of our credit
Credit-
says 365 days.
Okay. It will be your credit sales. Credit sales multiplied by what? Your receivable days. Receivable days divide by what? The number of days given in the year. If you are given, some question will give you 360 days, some question will give you 365 days. So don't come up with your own question. Once the question is telling you 360 days, or the question is telling you 365 days, work by what the question is telling you. Don't begin to tell the question that, well, the number of days in a year is 365. I have some questions whereby the number of days in a year given is 360 days. So when you are solving, you solve based on what is given. Don't say it is 365. So follow what the question is telling you to do. So for you to determine finance cost, it is your receivable balance multiplied by what? Your interest rate. And how will you get your receivable balance? Your receivable balance will be credit sales multiplied by receivable days divided by 365 days. Let's take this example to illustrate what we put down here. Now, example.
Mr. Tope, good evening.
Good evening.
Your voice is kind of far. I'm struggling to hear you. I don't know whether I'm the only one.
Please, can any other person hear me well?
Yes, sir.
We
I can hear you, sir.
Now, I think it's from your end, please. I'm very close to my laptop. So we have an example here that we can look at to buttress what I've just put forth. Can say XYZ company has sales of 20 million, $20 million for the previous year. For the previous year. Receivables at the year end. Receivables at the year end were 4 million. 4 million. and costs and cost of financing. Financing the receivables, you can say, is covered. It's covered by an overdraft. It's covered by an overdraft. And the interest at the interest rate of 12% per annum. 12% per annum. You are required to calculate the receivables. Calculate the receivables. The receivable days for SYZ. SYZ. And B, you can also calculate the annual costs. Annual cost of financing. Annual cost of financing receivables. Now, from this question, to determine our receivable days, what are we going to do? To determine our receivable days, what are the variables we need?
Receivable over sales times 365 days.
Okay. Receivables all over days multiplied by 365 days. So looking at the question, that SYZ company has sales of what? 20 million for the
20
previous
million.
year. Yes. So receivables at the year end were 4 million. And cost of financing receivable is covered by an overdraft and interest rate of 20% per annum. So to determine your receivables in days, your receivables that is due as at the end of the year is what? It's 4 million. Your overall sales for that period is what? It's 20 million.
4 million.
The overall sales for the period is 20 million. Multiply by 365 days, you get your receivable days.
73 days.
Okay, 73 days. Let's show it. This is a build up on the first class on working capital. So receivable days will be equal to what? Be equal to your receivable days will be equal to 4 million divided by what?
20 million.
Million.
Divided by 20 million. Multiply by what? Multiply by 365 days. 365 days. And when you do this, the number of days will be what?
73.
The number of days will be 73 days. Now, the main question I want us to solve is the issue of the cost of financing. What will be the cost of financing the receivable?
4 million.
The cost of financing the receivable. When you go to the question, you'll see that your receivables at the year end is 4 million, right? Cost of financing receivables is covered by an overdraft at the interest rate of 12%. Now, let me explain what this statement is all about. Now, the point is this. When you have receivables and you need immediate cash, you can quickly run to your bank to get an overdraft. The overdraft can be at the rate of 12%. So once the customer pays you back, you give the bank their money, including what? That is the concept we are referring to here. The costs of financing the receivables. So as we go on in the class, we will see various aspects of managing receivables. So now, the costs of financing 4 million will be what? It's 12 million. 4 million is what? Is 12%. So your cost of finance your cost of finance will be what? Cost of financing receivables will be 4 million multiplied by what? 12%.
12%.
So
480,000.
yes, so if you get 4 million from the bank because you need money from the bank urgently, what will be the cost to you? The cost will be what? 480 million. 480 million. Now, let me quickly make some issues very clear. When we talk about discounting, cost of financing, what we are referring to is that discounting is the process by which a bank or financial institution gives immediate cash to a business for a bill of exchange before its maturity date. That is after deducting a discount or interest. So in simple terms, I would say that the banks pay you earlier or subtract some money as its fee. So when we talk about receivables management can be in form of you in need of cash at the immediate, but because you cannot go to your customers, you've already given them 3 months credit, but because you need cash even before the 3 months elapse, you can run to your bank. You can run to factoring agents, and they will come to your aid to give you certain money. For example, suppose a business sells goods worth 100,000 naira to a customer on 3 months credit and receive a bill of exchange likewise. So the business does not want to wait for 3 months. So it takes a bill to the bank. So what happens the bank agrees to discount the bill, let's say at 10% annual interest rate. So it means that the payment, the discounting rate will be what? Will be 10% of what? Of that 100,000. But within how many months? 3 months. It will be 3 all over what? All over 12. 3 all over 12. So now, this is talking about the financing of receivables. Financing of receivables. We can have a case whereby when you give your customers credit and your customers decide to pay you earlier than expected, or you can give a condition that if you should pay me between 1 month, this will be the discount. That is early settlement discount. Early settlement discount. So sometimes for prompt or for a business to get cash very fast, they can give a discount. So cash discounts are given to encourage early payments by customers. So the cost of the discount is balanced against what? The savings the company received on time. That is the money the companies received on time. So for you to determine your discounts, there is a formula we need to know, and we need to refer ourselves to likewise. That is it is called the annual cost of discount. The annual cost of discounts. Let's see if I have it here. The annual cost of discounts. Yes, this is it. Annual cost of discounts. In some literatures, it will be in another way, but I've decided to simplify it. Let me write it in another way. Annual cost of discounts. This point here, this denominator here, it can be amount led to pay. Amount led to pay. But I decided to break it down and say amount led to pay is 1 minus discount.
Sir, please, I can't see your screen. I've been out of this thing for about 10 minutes. I'm only just hearing your voice.
Please, can any other person see my screen?
We can see your screen, sir. We can see your screen.
Let me share my screen. So we can have a formula to determine our annual cost of discount, which is this. Now, let's take notes of something in this formula. This number of periods is very important. Some questions will give you the period in year. Some questions will give you in days, 365 days. Some questions will give you in weeks, that is 52 weeks. Some questions will give you in months. So we have to be very careful about that aspect in the formula. So where number of periods can be 365 days, it can be 52 days, it can be 52 weeks rather, it can be 12 months. So let's take note of that. Let's take note of that. So in trying to solve questions using this approach, we can come up with an example. Let me see if okay, I don't have the examples there. I'm not using this slide, so I'm just we can come up with an example to see how we can use that formula. After this class, I'll refer you to this topic in the ICANN study pack, and you see all what we are discussing here. You also read through them there likewise. So they are very important. So that is why I'm referring you to I'll refer you to the study pack. In case you don't have it, I'll forward it to the platform as soon as we're through, so that you see that they are all issues from the study pack. Let's look at this example. We have this example. Let's say a company is offering a cash discount. The company is offering a cash discount of 2.5% to receivables. If they agree to pay debt within 1 month. Pay debt within 1 month. The usual credit period. The usual credit period taken is 3 months. Is 3 months. The question is, what is the effective annualized costs of offering the discounts? Madam Comfort, can you hear me well now?
Yes, I can. Thank you. Thank you very much.
All right. And should it be offered? Should it be offered if the bank would loan the company? The bank will loan the company at 18% per annum. So this is a question that a company is offering a cash discount of 2.5% to receivables if they agree to pay the debt within 1 month. The usual credit period taken is what? Is 3 months. Is 3 months. So if I should pay within 1 month, how many months am I saving?
2 months.
If I should pay, I'm saving 2 months. I'm saving 2 months. See it. The usual period credit is given is what? Is 3 months. So if your debtors agree to pay you within 1 month, it means there is a savings of what? Of 2 months. The question is, what is the effective annualized cost of offering the discount? The effective annualized cost of offering the discount. And should it be offered? So the question I want to ask is this. If we are saving 2 months, 2 months in a year, how many months are we going to save overall?
Six
How
months.
many months are we going to save? 6 months. 6 months. 6 months. I don't know if If every other person understand that is 6 months.
Sorry,
I
come
did
again
not
to give me.
understand. Rice explain.
A company is offering a cash discount of 2.5% to receivables if they are able to pay debt within 1 month. The usual credit period taken is what? Is 3 months. So 3 minus 1 is what?
2.
2. You're expected to pay your debt within 3 months. But the organization is trying to say if they are to allow you pay within 1 month, they are going to give you a discount of what? 2.5. Of 2.5. Now, if you are paying within 1 month, how many months is the organization saving for them to quickly get back their money? They are
2
saving
months.
2 months. So how many 2 months will you get in a year?
6
12
months.
divided by 2. How many months make a year?
2 months.
See the question. The question is referring you to months. Within 1 month, within 3 months, isn't it? How many months do you have in a year?
12 months.
So how many months will you save in
6 months.
a year?
6 months.
Yes, 6 months. It means that if I'm getting a loan for like 6 times, for 6 times, or for every 3 months in a year, every 3 months, yes, within the year, and I'm paying back within 1 month, I will save what? 2 months. So within that year, so 12 divided by 2, it means you save 6 months will be saved. The organization will quickly get back their money, you understand, and save cost of financing that receivables. So now, going back to the formula, everybody write down that formula in your book. This formula here, where is the formula?
Sorry, sir, I have a question.
Yes, ma'am.
So now,
I mean, I've not been
I
able
understand
to
that you
view
said
your this
6
thing up
months.
till now.
So let's assume that it takes 3 months to pay in a year. That will be 4 times, right?
4 times. It means you are
Good.
not, you are fine. It
That will
means
be 4
you are
times.
not following you don't want to enjoy the discounts the
So
organization is
now,
giving.
if there's now discount and I'm able to pay once, that's in 1 month. It simply
Yes.
means 2 months, it's safe 4 times. So shouldn't it be 8 months?
No.
I
8
don't know
months.
if I'm
How will you get 8 months?
because
I was
if
I
we are
was
to
reason,
borrow
I was
3 times
reasoning
4,
towards the question that she asked truly.
because 3 times 4 is 12, sir. That means we calculate 3 months in a year. That's 4 times to give us 12 months. Now we are saving 1 month per each
You are
3 months.
saving 2 months. 2 months.
Sorry, we are saving 2 months per each
Yes.
3 months. Already,
Yes.
the 3 months was originally divided into 4 to give us 12 months. Now we are saving 2 months into 4
Yes.
places. It's going to be 2 times 4.
You are saving 2 months
Yes, into 4
into
places.
Hello?
4 places.
Yes, yes, there should be 8
Okay.
months. Because if you say we are saving 6 months, it simply means that the loan is valid for 4 months. So that when we save, if we're able to pay in 1 month, then we have 3 times 4 to give us 12. But if the loan validity is supposed to be 3 months, it simply means we have 3 months, 4 times in a year. So if we have 3
Okay.
months, if we have 3 months, 4 times in a year to give us 12. And now we are enjoying the benefits of 2 months less. It simply means the 2 months
Yes.
still times 4. So I'm thinking it should be
Okay.
8 months and not 6 months. I don't
No problem. I get your argument. Yes, let me hear from Mr. Isa.
Yes. Good afternoon or evening, sir.
Minister.
Based on what Madam George just explained, if we are to go by that, now the 3 months now we have, if we divide 12 months by 3, that means we are going to have 4. So that 4 now, out of the 3 months, we only give 1 month from it, left with 2 months. And the 2 months now, if we consider it by the 4 that we are to consider for the year, that means we are going to get 8 months out of that 12. That is the aspect that I was reasoning before you explain 12 divided by 2 to get 6.
Okay, I get your point now. This is it. Now, let me go back to the question. Okay, so now from the question, if you are not going by the, if you are going by the 3 month period of credit, right? If you're going to pay the your debts within 3 months, it means the number of period you will have will be what? Will be what? Will be 4, right?
4. Yes, sir.
Okay, 4, fine. Within 3 months, 4. Now, if you are not paying within 3 months, you are paying within 1 month. Within 1 month. How many months will you have as extra? How many months will you
2.
have? It will be
2.
2. 2 months.
Mm.
2 months.
For the first 3 months, we are having 2 months now.
Fine. For the first 3 months, you're having 2 months, right?
Mm.
So the point is this: 2 months. And how many months do you have in a year?
12.
We have
12.
12 months.
12 months in a year. So if you have 12 months in a year and you are saving 2 months for every 3 months, how many months will you save?
That is
8
6
months.
months.
6.
It
For
means
every 3,
that for every 3 months you are paying within 1 month. You are
Yes, yes.
saving how many months? 2 months.
2.
So within 12 months, how many months will you save?
8.
6 months.
How I get to your 6? Sorry.
In fact, I did one funny stuff. I counted 12, like 1, 2, 2, 3. So I counted 2, 2, 2, 2, 2, 2, like those primary school
Don't tell you.
digits.
That is tally.
To give you
That is
6.
tally. So the 6 is the 12 months you have in a year. Divide by the 2 months you are saving. The 2 months you are saving. 2 months in 3 months is 1 for the first period. So for overall 12 months, 12 divided by 2, you have how many months in 12 months? 12 divided by 2.
So except we're dividing 12 by 2, it will give us 6. But
Let
if
me
we're going by
write it out. Solution. Let me start with let's go back to that formula. Let's start with it so that we can as this formula. So let's start with this so that we get it as appropriate. Now, going by this formula, to get your annual cost of discount, from this formula, we'll have it as what? Your discount is what? The
2.5%.
value of the discount.
2.5%.
2.5%. This value here amounts to let's pay, but I'm putting it as 1 minus discount, so that when you go to other literatures, you begin to look for how to determine it. Your 1 minus the discount value here will give us what? 1 minus 2.5.
1.5.
Okay.
Okay, sorry, let me see something here. 1 minus 2.5. Okay, let me see. 100 now. 100 minus 2.5. It should be 100, please.
No.
Yes, this should be 100.
That's on the formula.
That is 1.5, right? Let me see. 1 minus
1 minus 2.5 to minus 2. Minus 1.5.
minus 1.5. So it's 100 minus that discount value.
That's 97.5.
97.5.
Yeah.
So why are we using 100?
The formula changed.
Because it's in percentage.
The 2.5%.
So now the number of periods, let's come back to it now. The number of periods, that is looking at the annual cost of discount. That the usual credit period taken is what? Is 3 months.
3 months.
3 months.
3 divided by 12.
Now, we are giving you an offer that if you pay within 1 month, you're enjoying 2.5% discount. So if you are to pay within 1 month, how many months will you save? What will be the benefits of going by this option?
You will save 2 months out of the 3.
So when you are saving 2 months out of 3 months, in 1 year, in 12 months, how many months will you save?
8 months.
You said?
Yeah, I got 8 months. So
And I want to know how you getting 8 months. The way to get the months is 12 divided by 2.
okay.
The
So
way
6
to
12
months.
divided.
okay.
Let me just write it.
If it's
Let me
12
write
divided by 2, then it's 6 months.
savings. Let me write it. Savings. Savings is 2 months. It's 2 months. And there are, let me say, and there are 12 divided by 2 will be equal to what? 6 period. 6 period. 6
Sorry,
period.
good evening, sir.
Good evening, ma.
Okay, so I think that maybe for instance now, maybe because of that month save that some of us are having the issues with, I think maybe if we say that if, like for instance, if we use a different days or month, that you have 4 months and you use 1 month and you have 3 months save, it's going to be 12 divided by the 3 months save. That's 4 months. Maybe to understand it, instead of doing 1 month save, 2 months save for each quarter to have 8. I don't know if
Okay, that's if we have we'll say 4 months, right?
yeah, if we have 4 months to pay the credit facility and we pay
Okay.
within 1 month, we save 3 months. So that
You
3
say
months, that the remaining month in a year will be 12 divided by 3, which is 4.
yes.
So I don't know if we just say that is the formula to get the remaining months saved annually.
Okay. That is another
Make it
in terms
clear.
of
Another scenario.
I think it's better we tackle it once and for all. What if this question
hello.
comes up?
I think you are referring to another scenario, right?
Yes, as another scenario, so that it will be clear. We don't have to be doing. If we go by what she did by tally, we'll have 8. But if we go by what you have explained as the formula to get the remaining months saved in that period, we have 12 divided by 2. So I'm just saying another scenario, we have 4 months, we pay within 1 month, and we have 3 months left saved. That will be 12 divided by 3, which is 4 months in the year that is saved.
Yes. It's to me it's a very straightforward something that you have a period of 5 months to pay. Now I can't tell you that if you pay within 1 month, you will get a discount. How many months have you saved? 4 months. In a year, 12 divided by 4, you have 3 periods. You have 3
Okay.
periods in a year because you are getting the loan. You are getting the 3 month loan. How many times in a year? 4 times in a year. 4 times in a year. So when you save 1 month within those periods, how many months will you save overall?
2
So
times
that
4.
is 12 divided by 2. You have it as 6 periods in a year. 6
Okay.
periods in a year. So going by the number of periods saved, these will be raised to the power of 6 When we simplify this value here, what will be our outcome? Is 2.5 divided by 97.5. The outcome will be what?
0.02564.
So we can have this to be 1 plus 0. What? 256. 2564.
Okay.
So the
Okay.
power of 6 to the power of 6
Okay, so is it to
minus
the power or times?
is to the power of 6.
Okay.
That means now it will be to the power of 5. 600.
To the power of 6 minus 1. So we have it as what?
16.405.
Okay. $16.405. £16. Everybody, we are getting 16.405, right?
No, Mr. Tope, I don't know if it's my calculator though, because I notice I'm having issues with the setting with my
Yes,
calculator.
it's correct.
I think it's my calculator.
16.405.
Percent.
Yeah. So the question wants us to determine what is the effective annualized cost of offering the discount, and should it be offered if the bank will loan the company at 18%. Now, we are trying to compare if we should get a loan from the bank within that 1 month at 18% and give a cash discount of 2.5 at the rate of 2.5%, which is beneficial. Is it
Giving a
for us?
cash discount of
Even
2.5.
the discount.
So giving a cash discount, and why is it beneficial? Why are we going by that?
Because it has a lower percentage now that he will spend.
So the decision is the loan rate. The loan rate is 18%. The loan rate is 18%. If you are to get the loan, and you get 16.05. So it is better you offer the discount and get your money very fast, because you incur more when you get the loan from the bank. So this is trying to use the annualized approach. Trying to use the analyzed approach. Let's look at okay, because of time, because my battery will soon go now. I'm not because of time. Yes, what is the question?
Okay, sir. Sorry, sir. What I wanted to say is, okay, can we put it in when replying when answering this question now, you'll be like because cost of maintaining the debt via offering discounts is better than collecting from the bank. That's cost of maintaining this thing. Cost of maintaining I don't even know. Cost of maintaining the receivable, sir.
All right. Yes, is same thing. So now, when we're trying to to maintain our receivable balance or receivable level, and you need cash. And in a way to quickly get your cash, you can use your discounting approach and you can use your factoring techniques. When we talk about factoring, what are we referring to? Factoring. Factoring.
The means of getting receivable quickly, engaging a third party.
Okay, engaging
The
a third
service of
party.
of a factoring company.
Okay. Yes, just as she has said, is outsourcing of credit control to a third party. To a third party. So that third party will be the person or the organization following up with your debt. It can be in two forms. It can be in two forms. We can have a recourse and non-recourse. A recourse and non-recourse. That is when we have the issue of recourse, it means that what? The implication is that the responsibility of administering the debt, the responsibility of administering the debt is just with who? With the factor agent. It's just with the factor agent. That is the debt collection and administration. That means that when there is bad debt, they will not be involved. But where we have a case of non-recourse, where the factoring agent is accepting the mandate, the responsibility of non-recourse, it means that they bears the cost of bad debt likewise. But where it is just recourse, that is factoring recourse, they only work on the administration of the debt collection, and anything that has to do with the bad debt of the receivables, they are not involved. And when it has to do with the non-recourse, the issue of bad debts will also be part of their mandate. Also be part of their mandate. So the debt collection and administration, the factor takes over the whole of the company's sales ledger, the issuing invoices and the collection of debt procedures. So when we discuss the issue of factoring, we can use an example to illustrate this. Factoring. Factoring is you handing over your debt collection process to a third party for them to. Now, the factoring process, for example, the company sells goods to a customer payable in 30 days. What will happen next? The company sells the debt to the factor. All my debt issue, take it. As the company sells the debt issue to the factor, what will happen? If the customer pays the factor or pays the debt back within 30 days, it's the factor that will get the debt, that will collect the debt. As the factor collects the debt, what happens? The factor pays the company unless any administration fee or administrative costs that have been incurred. That is where it involves the issue of administration and just debt collection. But where it involves the issue of financing, when financing is involved, that is, the issue of bad debt is involved. The company sells the goods to the customer within 30 days. What happened next? The company sells the debt to the factor likewise. And what happened? There can be an issue of the company getting 80% of the debt. So 80% of the debt will be paid in advance to to the company. So as the customer pays the factor back, what will happen within 30 days? The factor pays the company the balance. For example, you are expecting 80,000 from your customer. You decided to sell the whole 80,000 debt issue to a factor, and the factor pays you, let's say, 80% of 80,000. As your customer pays back the factor, what will happen? The factor will just give you your balance, deducting what? The administrative cost, the finance cost, because it is the factor that have followed up with the customer to get the debt back. So we have the case of recourse and non-recourse. So I'm going to, my system is down. I'm not in my normal location, so it's not light here now. So I'm going to forward an example so that we're going to look at it when we meet next. Yes, on this factoring. I have
Sorry, I want to ask a question, please, a quick one.
all right.
Does this factor, does it seem like invoice discounting?
Invoice discounting. Yes, it's similar to it. Yes, similar to it. Yes, because the factoring, how it works is, as I give you all my invoices, all my debt issues, as the customer pays back, I'm not giving you back everything. It's the issue of discounting is the first case we've looked at, Ma. The issue of discounting. The first case we look at, where you quickly run to your bank. So the bank will discount your bills for you. But the case of factoring now, it is either me buying your whole debt and giving you a portion of it. Or in case of me buying your whole debt and also incurring in case of any bad debt. So, but they work in similar line. Yes, they are similar, but with different working issues. So the case of bill discounting, can you tell us more about bill discounting, Madam Mary?
Okay, the invoice discounting is a process where, for example, you invoice your client and then you are expecting money just like receivables. So the bank might give you 70% on the value of your invoice and then on the fee. So it's, I don't know, that's why I asked if it is similar with this
Yes, yes,
factoring,
yes.
because it's on your invoice that the bank will give you money. So when your client pays, they'll take back their money plus the charges, the interest have been accumulated based on the agreed terms of the interest
Yes,
with you and the bank, something of that nature. So what
yes,
you're saying, it seems like it is.
yes,
I
that
don't
is
know
how
this
it
yet.
works. That is how it works. That is how it works. Like for example, let's say a business needs a cash flow because, and the factor decide to provide, let's say 80% within 24 hours of the invoice being issued. So the point is this: a bank providing an overdraft facility within that hours, and discounting it at 80% is also a form of factoring. Yes, it's a form of factoring. So it's just like discounting of bills. Likewise, discounting of bills. So it's 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 also discounting of bills. So because I quickly need cash, the bank can decide to give me certain percentage, and once the customer pays back, they quickly remove their money and the interest and give me back the balance that is due to you. Yes. So I have to go now. I don't want my system to go off without me leading the class. So
Thank
we're
you,
going
sir.
to meet.
Thank you so much, sir. Sir, silent.
Thank you.
Success in tomorrow.
Okay.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you, sir.
Thank you.